Hey guys, so on May 20th, I came up with a video here on YouTube and really all over the place, and I titled it "I'm Getting Bearish," and I wanted to give you a bit of a follow-up on that, kind of see where we are, and more specifically, give you a bit of an idea of where I think the S&P 500 specifically could slide to next. This is not a fear-mongering video, so if you're gonna label me as that, then you maybe should go back and kind of check my videos. It's not my point. I'm looking at it as a realist. One thing I will tell you though is that the raging bull market that we have been in over the past 10 years is probably over in the way that we know it. So blindly buying the dip, and this has really been the case for now 15, 16 months, but it's worth reiterating, that raging bull market is probably over. So it's getting more difficult. It's been more difficult for blindly buying the dip crowds over the past 15, 16 months, and it's going to continue to get more difficult. So with that, I wanted to show you guys a very simple chart of the S&P, and I'm going to show you guys what my downside targets are. This is not a recommendation. This is just for reference points. It's a follow-up to a video I made on May 20th. You can go to my YouTube channel, The Steady Trader, and you can see it there as a reference point, so you can kind of connect the dots. Just so you guys know, our market rover has been consistently and persistently getting more bearish every single day. We've gotten a whole lot more sectors in the red. We've gotten a ton more bearish reversals, B2 bearish reversals at these red arrows, pop-up trade alerts, a lot of them on the bearish side. You can see short, 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 short. And so this brings us to the S&P 500. And again, you know, I think the S&P is a good index to watch. It's not the holy grail. But here's sort of your big picture. So you can see we had what I think ultimately we're going to come back and look at as a fairly big topping process in the S&P that we had here in September of 18. And of course, we had a retest that just took place here in the, let's call it late April, early May period 2019. We're falling out of this rising wedge, which is something also I've been talking about now for months, for a couple of weeks, and we're now reverting to the downside. So far as of the recording of this video here, before the market May 29th, where the S&P has retraced about 5% from the all-time highs. That's not a whole lot. I think there's easily another 3 to 6% to the downside, which would probably get us closer into this zone here that I marked with the purple box, which is from about 2,700 on the upside of it to about 2,650, i.e. 2,650. So that's the range I'm looking for. Yes, that would mean we would break below this red line and the blue line, which is a 200-day and 100-day moving average respectively. But I do think that is kind of where we could go to from a Fibonacci perspective. If anyone here cares about that kind of stuff, it's interesting that this area, particularly the lower end of this range, actually lines up really well with a very simple 50% retracement. So if you take the entire rally from late December 18 into the May highs, this would mean about a 50% retracement. So if you measure this move here, right, from here to here, half of it, if you retrace half of it, you get to about 2,650. So this is just a reference point. But again, you know, I think what's more important is that people understand that that the market is constantly fluctuating, and you need to have a process by which you measure and map what the market does. You can't just wake up one morning and say, oh, it's broken below a 50-day moving average, time to short it, or it's broken above it, and you buy it. The market is much more complex than that. It doesn't have to be complex, but you do have to measure and map it, which is why we measure and map a ton of different indices and ETFs, and it's all being displayed on our market rover in a very, very simple manner with my daily commentary up here as well. And so, you know, we develop tools like these and a process like this to give people just that, to give people a process and ultimately, you know, perspective, because I think without that, it is very difficult to make money, particularly if you're in an environment, which I strongly believe we're in, and again, we've been in for 16 months, where the market is no longer just going to go straight up in a straight shot forever. You know, even if you look at the rally from, let's say, January through May, you know, it was very selective. Not everything rallied in sync. It was quite selective, particularly the latter part of that. So process. There's my S&P target. We'll see how it works out. See you guys soon. Oh, if you give us a thumbs up like if you enjoy this, or leave a comment down below, would appreciate that. Thank you.